Stocks is one of the most important skills for investors. There's no single correct way to value a stock, but there are several major approaches that professionals use depending on the company's type, industry, and growth stage. Let's go step by step. Number one, absolute valuation, intrinsic value. This tries to calculate what the company is really worth based on fundamentals. Discounted cash flow, DCF, estimate the company's future cash flows, profits, free cash flow. Discount them back to today's value using a discount rate, often WACC. Formula idea: text value equals frac CF1 1 plus R square 1 plus frac CF2 1 plus frac CFN 1 plus RN. Best for stable, mature companies where cash flows can be estimated: banks, utilities, big tech. Dividend discount model, DDM. If the company pays steady dividends, value it as the present value of future dividends. Gordon growth version, P equals frac D1 RG, where D1 is next year's dividend, R is required return, G is dividend growth rate. Best for dividend paying companies, banks, consumer staples. And number two, relative valuation, multiples. Instead of calculating intrinsic value, you compare the company to similar businesses. Price to earnings, PE ratio. Compare stock price to earnings per share, lower than peers, undervalued, higher, overvalued. Price to book PB ratio compares price to company's book value, assets, liabilities, useful for banks, financials. Price to sales, PS ratio, good for startups or companies with low negative earnings. EV EBITDA, enterprise value versus earnings before interest, taxes, depreciation, and amortization. Removes capital structure differences. Best for comparing companies in the same industry. Number three, qualitative valuation story moat. Numbers alone aren't enough. Also look at business model, how does it make money? Competitive advantage, moat, brand patents, network effects, management quality, industry growth trends. Number four, quick rules of thumb, PEG ratio, PE, growth rate. PEG 1, often undervalued. Rule of 72, how fast earnings double, 72 growth rate. In practice, analysts usually combine methods. For a growth stock, focus on DCF and PS. For a dividend stock, DDM and PE. For a bank, asset-heavy stock, PB and EV/EBITDA. Would you like me to make you a step-by-step checklist like a personal formula that you can use to value any stock quickly before deciding whether to invest?